Hi, everybody. Let's try to condense a Finance for Non-Financial Manager course into a simple video. Here we go. Hi, everybody. It's Mike Andrew. This is the time of the year where many companies are announcing, if they haven't already done so, their financial earnings, their financial performance for the previous year. And so I thought I would just give a quick recap of Finance for the Non-Financial Manager, looking at two fundamental financial statements: the income statement, also referred to as the P&L or profit and loss, and the balance sheet. Now, many training firms try to throw in cash flow statement, which is important. But in my opinion, for executives, they don't need to get into that because it's a complicated formula that accountants need to figure out and calculate. Executives and managers, they just need to know how much cash do we have? Do we have enough cash to run our business without having to borrow any money? But I'm going to get into that. So the income statement and the balance sheet. Let's start with the income statement. The income statement answers this question: how well did we do? How well did we perform? And did we perform better this year than last year? At the same time, are we trending in a more positive direction with our revenue growth and profitability growth? And did we perform well according to our plan? And are we performing well in comparing to our competitors and industry standards and so forth? The P&L, or the income statement, is broken down as follows. At a very high level, it's total revenues or sales minus all your costs to give you income. Very simple. But they break it down further so they know where to control and manage and where to target for more profitability. For example, the income statement starts with total sales or revenues minus cost of sales. What were the costs directly associated with generating those sales? And that gives you the first profitability measure: gross profit. So if gross profit this year was 45%, but last year was 48%, why is it lower? We have to pay attention to that. Maybe there's a good reason, but we have to pay attention to that. From the gross profit is where almost everything else is deducted, called operating expenses or OPEX. And when you deduct all the operating or OPEX from your gross margin, you get what's called operating profit or operating income from our operations. And then from the operating income, you break it down even further and you deduct taxes paid, zakat, a Middle East zakat, interest that we've earned on our cash, or interest that we paid. Those are non-operational. And that gives you net profit. So the three levels of profitability is gross profit, operating profit, and net profit. Now, there's one profitability metric not mentioned there, but it's really critical in my opinion, and it's called EBITDA, EBITDA, earnings before interest, taxes, depreciation, and amortization. And why is that important? It's important because it's in my opinion, the true measure of profitability from our operations, because it factors out amortization and depreciation, which are non-cash accounting mechanisms. So get that out of there. And it factors out interest that we've earned, which is non-operational, interest that we paid on loans, non-operational, taxes that we paid, or zakat that we paid. So the true measure of profitability, in my opinion, of our operations is EBITDA, earnings before interest, taxes, depreciation, and amortization. On the other equation, the other financial statement is the balance sheet. And that answers the question: how healthy are we? How healthy are we financially? How healthy are we with our cash position, with our debt, and so forth? Are we managing the business with too much debt? Just like your household. How healthy is our cash position? And do we have too much debt, too much credit card debt, too much mortgage debt, and so forth? So the balance sheet, the fundamental formula, 100% will always be assets equals liabilities plus equity. And assets are broken down into current and long-term. Current assets are your cash, receivables, money that's due to you by customers, inventory that you expect to turn over into cash and sales within a year, and short-term investments and so forth. And long-term assets, which is property, plant, and equipment, buildings that you own, and so forth. And on the other side of the equation is all your liabilities. Also current and long-term. Current liabilities are those liabilities you expect to pay off within a month or two, certainly within a year, but within a month or two. And long-term liabilities, like mortgage on your house. And what's left over is your equity. Equity requires a whole separate video about what we include in equity. So it answers that fundamental question: how healthy are we? Do we have good cash position? How is our debt position? The way I look at it is, if I want to get a sense of cash, I look at something called working capital. All your current assets minus your current liabilities, and that gives you an indication: how much cash do we have to sustain the business for a while without borrowing money? Or you could look at current ratio, current assets divided by current liabilities. Rule of thumb for me has always been 2 to 1. So if it's 2 to 1 or higher, you're in a pretty good cash position, pretty good liquid position. And I also like to look at debt. And I look at long-term debt to equity. And rule of thumb I use, if it's 30% or less, the company's in good shape. Now, it might be higher, and there might be good reason for it. There might have been strategic decisions made. There's always reasons behind some of these numbers. And one other metric I will look at is return on equity, and that is how effectively has management used its investment capital to generate profit. So that's a big one with Wall Street analysts, ROE, RO equity. ROA is another one, return on asset. How effectively are we using our assets to generate income? So current ratio, working capital, debt equity, and return on equity or return on asset. Finance for the non-financial professional. Thank you for listening.